told you the real estate market isn't crashing, it's resetting. And the people who understand what's happening right now are going to win in the next 5 years. The 2026 Vision Speech laid out the numbers driving real estate, the economy, mortgage rates, inventory, and even generational wealth. Today, I'm breaking down what actually matters and what it means for you. The 6 numbers driving the real estate market. There are 6 core drivers: home sales, home prices, market value, inventory, mortgage rates, affordability. Let's simplify this. Home sales. Yes, sales are down from pandemic highs, but those highs were abnormal. We are not at crisis levels. We are operating below peak, but above recession lows. That's not a collapse. That's normalization. Home prices. Historically, real estate appreciates around 4% per year, long term. Did we grow faster than that in 2020 through 2022? Absolutely. Was that sustainable? No. What we're seeing now is slower appreciation, not a crash, a slowdown. That's a very different story. Inventory. A balanced market is about 6 months of supply. We are still below that. That means we do not have a flood of homes hitting the market. We do not have a foreclosure crisis. We do not have a wave of distressed sellers. Limited supply protects prices. That matters. Mortgage rates. Rates moved above fast. That shocked buyers. But historically, today's rates are near long-term averages. They only feel high because we came from record lows. Here's what's important. Rates slow demand. Inventory shifts value, and inventory is still tight. The bigger picture, the economy. Let's zoom out. GDP is stable, unemployment remains historically low, and housing crashes don't happen without massive job loss. We are not seeing that. Hiring has slowed down in some industries. Healthcare remains strong. Employment drives housing, and employment is stable. Wealth and the generational shift. Here's something powerful. Baby boomers control nearly half of U.S. assets. Trillions of dollars are tied up in real estate. We are entering the largest wealth transfer in history. That means downsizing, inheritance moves, gifting equity, investment reshuffling. Real estate will play a major role in that transition. This is not shrinking. This is not a shrinking market. It's evolving. Inflation and the Fed inflation has cooled significantly from its peak. When inflation cools, the Fed eventually adjusts mortgage rates, follow Treasury yields more than the Fed directly. But direction matters. We are likely entering stabilization, not acceleration. Economic risks of 2026. Are there risks? Yes. Policy shifts, labor softening, AR market corrections, tariffs, global tensions. But what actually impacts housing? 3 things: the price of real estate, the cost of money, and employment. As long as employment stays stable and inventory stays constrained, the housing floor remains stronger than headlines suggest. What we're seeing inside real estate: prices have increased. Luxury homes are taking longer to sell. Volume per agent is compressed, but distressed sales remain extremely low. Underwater homeowners are near historic lows compared to 2008. This is not a crisis behavior. This is an adjustment behavior. The frenzy is gone. Strategy is back. Final takeaway: we are not in a crash. We are not in a boom. We are in a reset, a market where pricing matters, negotiation matters, guidance matters. The next 5 years will reward people who understand data, who think long-term, and who move strategically. Real estate has always been cynical, and it has always been resilient. If you want to understand how these national trends affect our local market, that's where strategy becomes personal. Because vision without strategy is just noise. And in this next season, it belongs to the informed people.